Hi everyone, it's me. I have never in my career seen such a huge amount of volatility and change in the markets and in our world than we are experiencing today. Change is the one constant that we can count on, and I want to share with you three important concepts around change that I believe will be very valuable for you as investors. This is a topic that I teach in some of my advanced investment classes, and it's something that I've thought about quite a lot over the past several years. First concept is trend recognition. If you have been following the markets for any length of time at all, you know that sometimes there are trends that develop that last for months or even years. For example, from 2009 through 2020, there was an uptrend in the markets. Obviously, there were corrections along the way, but the overall trajectory was up. From 2020 through 2022, we experienced a downtrend, and right now, we are trying to figure out where we are in the markets. Is this the bottom? Are we going to go lower? Or is this a good time to start buying? Well, right now, we don't know the answer to that. But what we do know is that the longer we stay in the markets, the more likely it is that we will experience both uptrends and downtrends. And we need to make sure that we have our portfolios positioned to take advantage of those trends. There are two types of trends that I want to talk about. One is what I call a secular trend. This is a really long-term trend that lasts for many years, if not decades. The other type of trend is a cyclical trend. These are trends that last for months or even a few years. Secular trends tend to happen when there is a big shift in the way people live their lives or do business. Think about how the internet changed the way we shop or how smartphones change the way we communicate. Those are examples of secular trends. They're big trends that have lasted for many years. Cyclical trends, on the other hand, are a little bit shorter term. These are trends that happen because of the ups and downs of the economy. For example, during the pandemic, we saw a boom in e-commerce. That was a cyclical trend. People weren't going into stores to shop. They were shopping online. So e-commerce companies did really well. But as the pandemic ended and people went back to stores, that trend ended. One of the best ways to identify trends is to keep up with what's going on in the markets. That means reading the news, talking to other investors, and staying informed about what's happening in the economy. Once you have identified a trend, you need to decide whether or not you want to go along with it. If you decide to go along with the trend, you need to invest in companies that are benefiting from the trend. If you decide not to go along with the trend, you need to either sell your investments in those companies or short the stock. Shorting a stock means betting that the stock is going to go down in price. If you think that a stock is going to go down in price, you can sell the stock and then buy it back later at a lower price. If the stock goes down in price, you make money on the trade. But if the stock goes up in price, you lose money. The second concept is strategic timing. This is the art and science of buying and selling at the right times. There are many different ways to time the markets, but the most popular methods involve looking at technical indicators or economic data. Technical indicators are statistics that are calculated from the prices of a security. They're used to help investors identify trends and make trading decisions. Some common technical indicators include moving averages, relative strength index, and MACD. Moving averages are used to smooth out price data so that you can see the underlying trend. A simple moving average, for example, is just the average price of a security over a period of time. You can use a moving average as a support or resistance level. A support level is a price level that the price of a security doesn't go below. A resistance level is a price level that the price of a security doesn't go above. Relative Strength Index, or RSI, is a technical indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the market. The MACD, or Moving Average Convergence Divergence, is a technical indicator that shows the relationship between two moving averages. It can be used to identify trends and momentum in the market. Economic data, on the other hand, is information about the overall economy. It can be used to help investors make long-term investment decisions. Some common economic indicators include GDP, inflation, and unemployment. gross domestic product, or GDP, is the total value of goods and services produced in an economy. Inflation is the rate at which prices are increasing in an economy. Unemployment is the percentage of the labor force that is unemployed. By looking at economic data, investors can get a sense of how the economy is doing and make decisions about where to invest their money. Now, let me be clear, nobody can time the markets perfectly. Even the best investors in the world have missed out on some big trends. But by understanding trends and economic data, you can put yourself in a better position to take advantage of them. So let me give you an example of how this might work in practice. Let's say that you are a fund manager and you manage $1 billion in assets. Your job is to make money for your clients by investing their money in the stock market. To do that, you would first have to identify a trend in the market. Maybe you notice that electric vehicle stocks are doing well, so you decide to invest some of your fund's money in an electric vehicle company. Then you would have to time the purchase of the stock. In this case, you might look at the stock's price history to find a good buying opportunity. Maybe the stock has been trading at a low price relative to its peers, or its price has been declining over the past few weeks. If so, you might decide to buy the stock now in the hopes that it will rebound in price. Finally, you would have to monitor the investment and be prepared to sell if the trend ends. In the electric vehicle industry, for example, there is a lot of competition and new companies are entering the market all the time. If one of these new companies threatens to take market share away from your electric vehicle company, you might decide to sell your investment. Timing is obviously a difficult thing to do, but by understanding trends and economic data, you can put yourself in a better position to do it. Concept number 3 is economic adaptation. Every investor needs to understand the economy and how it works. The economy is constantly changing and evolving, and it's important to be aware of these changes so that you can adapt your investments accordingly. When the economy is booming, it's important to invest in companies that are poised to benefit from the growth. When the economy is in a downturn, it's important to invest in companies that are able to weather the storm and come out ahead. There are 4 phases of the business cycle. The first phase is the trough. This is the bottom of the cycle and typically represents a time of economic decline. As the economy starts to recover from the trough, it enters the recovery phase. This is a time of growth and expansion. The economy continues to grow until it reaches its peak. At the peak, the economy is at its highest level of output and employment. But this is not sustainable, and the economy eventually begins to contract. This is the 4th phase of the business cycle, and it's called the recession. Eventually, the economy reaches its trough again, and the cycle begins anew. It's important to remember that every economy is different. There is no one-size-fits-all approach to investing. For example, some companies do well during recessions while others do well during periods of economic growth. It's important to understand the economy so that you can identify which companies are likely to do well during different phases of the business cycle. Once you've identified those companies, you need to time your investments accordingly. If you invest in a growth company during a recession, you are likely to lose money. That's because growth companies tend to be unprofitable or have very thin margins. They rely on the economy growing in order to increase their revenue and profits. When the economy is in a downturn, growth companies are likely to struggle. On the other hand, if you invest in a defensive company during a recession, you are likely to make money. That's because defensive companies tend to be profitable and have strong balance sheets. They are able to withstand economic downturns and often continue to grow even during recessions. Let me give you an example of how this might work in practice. Let's say that you are a fund manager and you manage $1 billion in assets. Your job is to make money for your clients by investing their money in the stock market. You've been following the economy closely and you believe that a recession is on the horizon. What should you do? Well, you know that you shouldn't invest in growth companies during a recession. So you sell your investments in those companies and you invest in defensive companies instead. If your hunch about the recession is correct, your fund will lose less money than the overall market. And if you're wrong about the recession, you'll still be invested in defensive companies, which tend to do well even when the economy is growing. In conclusion, the markets are always changing and evolving, and it's important to be aware of those changes so that you can adapt your investments accordingly. By understanding trends and economic data, you can put yourself in a better position to take advantage of the opportunities that are out there. Thanks for watching.